The Moving Iron Podcast is brought to you by these great sponsors. Are you looking to value your equipment more accurately, target the right buyers and close more deals, reach your ideal customer? Then look no further. Fusable isn't just about ag data, it's about action. Our best-in-class solution empowers you to value your equipment accurately, make informed decisions, and find the perfect prospects. Ignite your dealership's growth at fusable.com/movingiron-podcast. Out in the field, every decision counts. You wouldn't plant without testing your soil, so why would you prospect blind? Introducing EDA, your one-stop shop for ag equipment intel. EDA goes beyond specs and prices. You get deep dive data on every piece of equipment like UCC filings that help track ownership changes and uncover potential sales leads. D&B firmographics, which help you understand the financial health and buying power of potential customers. Market trends that help you stay ahead of the curve, and insights on equipment demands and pricings. With EDA, you're not just looking at data, you're seeing opportunity. Find the right buyer, sell smarter, and build lasting relationships. Visit edadata.com for your free demo and unlock the power of knowledge. For over 80 years, Iron Solutions has been your go-to data source for ag dealers, lenders, and manufacturers. Get powerful appraisal and value forecasting tools that fuel profitable decisions anytime, anywhere. Get your free demo at ironsolutions.com. Iron Solutions, confidence in every click. Today, there are many ways to finance ag equipment, but nobody delivers simple, fast, or flexible financing like AgDirect. Learn more about your options to buy, lease, and refinance equipment at agdirect.com. Valley Transportation has been hauling ag and construction equipment across the country for the past 33 years. Call Parker at 800-657-4910 for all your trucking needs. At Valley Transportation, our goal is to help you reach yours.
When you partner with Axon, you immediately gain access to a full range of products and solutions designed to meet the complex needs of today's grower. We carry all major brands and sizes of tires and wheels. We specialize in large diameter wheels for large equipment. We have one of the largest OEM replacement wheel inventories in North America. Known for extreme flotation setups, duals, and triples, we have wheels for all makes and models of tractors, sprayers, combines, and grain carts. If we don't have the wheel in stock, we'll custom build, sandblast, and paint in-house. There isn't a more vast inventory in North America dedicated to helping dealers move more iron. With facilities on the West Coast and in the heart of the Midwest, leverage our 230,000 square feet of indoor inventory to solve any problem a grower may have. Move more iron with Axon.
Moving iron in the 21st century. Hard-working people working hard for you and me. Moving iron time and time again. Through the years you'll find us here. Moving iron.
Hello and welcome to Moving Iron Podcast. I got Rich Posson here, the host of the Critical Point Podcast, back here on the show to talk about what's going on in the world of economics and all the other fun stuff Rich talks about. He's got a long laundry list of stuff that he covers on his podcast. So Rich, before we get into that, talk a little bit about your podcast and where people can find that at.
Yes, go to criticalpointpod.com. That's my homepage, and I blog a little bit and discuss some things. And you'll find some links to get over to free as well as locked up videos, audios, and a place to sign up. You can also go directly to the video audio host at criticalpoint.podbean.com. And what I offer is a subscription of just video audio. I don't put a newsletter like I did decades ago. And it's normally like morning updates, morning briefs, alerts at any time. And I'm not alerting you every second, all kinds of little fluctuations. I'm personally more interested in the larger trends during a year all the way to long term. But I do provide insight of, hey, is the market going down the next couple of weeks? Is it going down the next day or two? Things like that. And I show this, and videos are the best way to see it, that you can see how accurate the model is working, what kind of fluctuation do you want to become involved with. And I look at gold and Bitcoin and crude oil and the interest rates bond market. But the primary focus is stock market, economy, and the grains. But I do offer some of those other markets to get an insight because there are relationships between them. My focus derives from business cycle analysis that uses multi-level patterns, overlap pattern and performances, nesting patterns, and time cycles. I lump it together and I just give it an old-fashioned simple name of business cycle analysis. And I think it really beats most economists who really, they're good at figuring out the economics, but economics is more about history. They're not so good at figuring out the market, okay? And they can't move fast enough, think fast enough. And I'm more of like the market economist type trader, investor. And I've used my own analysis for 40 years now, trading stocks and commodities, and done very, very well. And I was able to catch the high in 2020 within 2 hours before that COVID crash. And the model was running 80% accurate all the way down when many of the big old pros on Wall Street were saying, nobody can calculate this. We don't know what's going to happen. My model was just saying, well, they're going to buy the next 30 minutes and then they're going to sell the next hour. And I was doing it again and again all the way during that crash. And it was just amazing to watch. I even made some money on the downside. And then 2 days after that bottom in 2020, I turned long-term bullish. And when I say long-term, I have patterns when we might be bullish and own for a year or two, but I have other patterns, maybe 4, 5, 6 years. I have other patterns for an entire decade. I even have a once a decade buy sell signal. And believe it or not, the stock market goes up 100 to 400% from that buy signal practically every decade throughout the history of this country. It also drops minus 20 to minus 50% per decade. I think that's rather important information, okay? It helps explain on the upside why so many people bet on the downside too often and are wrong, and then why they mess up when it comes time. This thing actually, for those interested in more of a business slant rather than the stock market, this thing will show us that high probability time and when we're going to have an economic recession and clobber the market, and our jobs and business and everything else. And so, at any rate, I've been doing this for like 40 years. And of course, I've learned along the way. And the model is actually designed to kind of learn along the way here, even though it's using my concept. And so that's what I do. And I try to keep things as brief and simple as possible. And I do send out alerts. So if someone is more of a long-term investor, they may want to ignore the morning briefs. It may just seem too redundant, too detailed, and they want to look at the weekly update. And sometimes I put out a monthly, but they definitely want to keep an eye out for the alerts, because that's when they also want to pay attention what's going on short term, because it may be a very, very important opportunity to buy or sell these commodities or stocks or bonds or whatnot. And I also will have an alert when I think we're going to have the economic recession. So I have a wide range of people following me, anywhere from very short-term traders to long-term investors to just businesses that just want to know what's going on with the economy, what's going on with the markets. So check it out, and they can also contact me at on X at Rich_Posson, and I use the same ping or address for Threads now. I am on Threads.
Oh, okay, all right. Right on. Okay, well, good stuff. Check out Rich's stuff. I listen to his stuff over on Apple Podcasts. So there's the free version stuff that comes up there. Check that out well with your time, and go check out his podcasts on behind the paywall as well, because there's a lot of great information there and a lot of really good videos he puts out there where he shows the charts and stuff like that. So it really understands the metrics that are working there. So, all right, Rich, got a laundry list of stuff to talk about today. Seen some action in the dollar. Interest rates are obviously a big point of topic conversation right now. As you look at what the Fed's been talking about, they've pretty much said, hey, September's the day. We're going to do it September. I hope they do it, because if they don't, there could be hell to pay in the markets. But the way things are shaping up, we got that. We got a job report coming out Friday. Plus, we had the JOTS job report that came out here last week. Got the economy as a whole, some stock market stuff, how the overall employment's shaking out with different stuff there. So commodity prices are all over the place, and we've seen some energy movement. So I guess probably set the table here, I guess, to kind of set the whole conversation up. Let's talk a little bit about what you see happening in interest rates, what you think the Fed is actually going to do, what not they're going to do.
And, what kind of rate adjustment do you think we're going to see in September?
Yeah. So my model has been bearish on interest rates, meaning we think lower interest rates are coming. And it's been bearish since last year. And if you go back and look at the chart, you can see we've been right. It has been working lower, but it's had sizable stabs to the upside at times. And the reason is the bond market keeps thinking the Fed's going to lower any day, and they just don't do it. And then it gets nervous that they're out of line and they got to get back into alignment. And so it's been a very slow developing bear market, but it still looks like it's on track to go lower. And after what the Fed spoke of here last week or so, it sounds like they're going to do it in September. So that is a problem in the sense that if they don't, you're right. There's going to be some fireworks in the wrong direction, or it comes back to burn us. So, even I'll be pushing that sell button there probably. But in the meantime, though, it looks like, we're on track that the Fed will probably lower in late September on their meeting. They should give us some guidance of how often they'll lower, how many times going into next year. And there are people out there, I think the Taylor people follow the Taylor rule developed by Taylor, who used to be on the Federal Reserve Board. Now he's a big money manager and this and that. The Taylor rule, from what I understand, is suggesting that the Fed should be at 4%. Here they are at over 5%. So that has made the market nervous at times that maybe the Fed's running a little too far behind, that even if they start lowering, it's not fast enough. So some are hoping they actually give us a 0.5 point cut, 50 basis points in September. I don't think they're really that concerned, frankly. I think they just feel like, hey, we got to start doing something before this gets away from us, comes back to bite us. I think they're probably going to lower a 1/4 point. I will applaud them if they lower a 0.5 point. It's what I would do. But unfortunately, if they might be thinking if they do a 0.5 point, they might think that's actually going to scare some people in the markets, thinking, oh, the Fed's waking up that things are slipping faster. And boy, they not got to get caught up. Maybe this just continues to slip and it's going to take a while. So I can see, tactic wise, they are, might want to be cautious, but frankly, I've just lowered a 0.5 point, and then I would talk my way around it saying, look, we just want to start off with a nice bang here, and we'll just do 1/4 points after that. And if we have to, we can take our sweet old time about it. And, I just feel like that's the better way of going, but I'll take whatever they get as long as they cut. If they don't cut, then my model is going to say, okay, get the blackboard out, get the chalk out, and the calculator. So anyways, it looks good to me. The JOLTS job report come out this morning. I haven't had enough time to run it through the model, but it's looking like it's benign. It was unchanged from the prior month. And the JOLTS jobs report simply says how many jobs are out there and how many were laid off and what's the turnover rate and things like that. And most people wanted it to come down. Even I did. It was unbelievably high going over the past few years. So bringing it down is just one additional factor amongst many that should encourage the Fed to say, hey, we're okay here. We're getting back to a normal economy. But at the same time, I don't think anybody wants it to drop a huge amount, because it would mean, boy, businesses don't want to grow. They don't want to expand. Yet the population still growing. Got young people come on board. To me, the JOLTS report on a long-term basis is just fine. It's standard operating procedure. There's still plenty of jobs out there. But it's also benign from the prior month, but it's also showing at least we cooled things off. Haven't gotten too carried away. Now, this Friday, we're going to get the monthly jobs report. That's different. That's actually assessing how many jobs did you create in the last 30 days? Okay, Mr. and Mrs. America. So, and that's a very difficult thing to forecast. And so I don't even bother anymore. I wait for the data to come out. I might have a hunch and the model may have a hunch, but generally I want the actual number, throw it in there, and then we want to see how the markets behave to it. I'm not expecting fireworks out of that. Some people think that jobs report is going to now become increasingly important along with unemployment, and people are going to pay less attention to inflation. That may be the case, but the most important news this month is going to be Federal Reserve. So that's what we want to keep an eye on. So that's my stance on jobs, that really we're doing well. It's okay to back off on the gas pedal there and back it off. We just don't want it to fall apart on us. And I'm not finding any evidence of that whatsoever. But there are people concerned about that. In fact, yesterday's selling in the stock market was a little bit of that concern, but most of it was just kind of seasonal game playing. They just love to sell the stock market this time of year. And already today, the market's trying to pick its head up. So I'm thinking maybe that selling is over for a little while. There'll be other waves of it here in the next 30, 60 days. We have to get through October to get out of that seasonal messiness for the stock market. But as far as that jobs input, I'm quite pleased how it's all coming together. The unemployment is up, but you have to realize we did something strange there after that COVID. We slammed that unemployment down all the way to the bottom and no time flat, and a matter of a few months. When normally, when you've had a recession and you slam the unemployment up, it takes 7 to 10, 12 years to bring that unemployment all the way back to the bottom to full employment. This time we did it in like 2 months. Recessions normally take 5, 7 months to 3 years. We did 2 months. So talk about being on steroids here. Things are different that, mom and dad and granddad didn't have to worry about, things come at us much faster on this data. And it was primarily just COVID, because it was just a strange thing we had never experienced before and just went into a recession so quickly. By some measurements, we were actually in a depression, but when you add everything up, no, we were not. And so we saved ourselves thanks to printed money and getting people back to work fast enough and this and that, get the lockdown. But it also, of course, helped spark that nasty inflation. Okay. And so for the moment, this whole unemployment thing, my model is saying, yes, unemployment can go higher in the first quarter of next year, but it also can stop going up this month. Now, I don't believe the Federal Reserve lowering rates this month will coincide with unemployment stopping this month. I think it's probably going to go a little higher later this year, but I don't see it staying up a long extended time. What we're seeing is knee-jerk reactions here just because we brought unemployment down so incredibly fast that I just feel like it can't go to zero. Well, it could, but I don't think we're going to hire that many people and be that robust of an economy. It just has to fluctuate. It has to move around and shuffle around. It's like trying to keep people in a line waiting to get in to see their opera or the rock concert. They're not going to stand there and not move at all. They're going to shuffle around. That's what unemployment's doing. Now, however, if the Fed Reserve does not lower in September, and I'm going to start getting nervous that they are too slow at this. And then the unemployment can go a little higher. And I think it could still stop in the first quarter of next year going up and still come down because the Fed can still lower rates in November and December. Okay, they will skip October unless they do an emergency cut. So that, to me, the Fed's on the right track. They really should lower now because we're getting one of those moments that we should be okay here. This could be a sweet moment now, but if we wait just a little bit longer, we're vulnerable to finally start breaking something. And so I understand some nervous by some people, but I've been at this enough and have enough faith in the model that it's doing the right thing of saying we will do the right thing. We will work through this. And it's bullish for next year for the stock market, even some or all of 2026. So I've been going in multiple directions here, but basically, I just don't see anything stopping us from lowering interest rates in the next year. The dollar is down this week. It was up last week. My model said it's supposed to be up. The model's warning it may go up the next 2 or 3 weeks even, and it may
Rich, I got one question for you. Back on interest rates. When you're looking at interest rates, obviously the safe bet's a quarter point, right? But do you think there's any way that they would do half, 3/4? Is there anything like that laying on the table that you think could be there?
I wouldn't see them doing 3/4 because I think that would send a message. They're scared something is freezing up or breaking and they got to move. And then that is going to scare the financial markets for a little while. And then if it doesn't come to fruition, then they'll say, okay, maybe that was a false alarm or maybe it fixed it. But the half a point, they could do it. To me, it'd be a nice surprise, but I am convinced. I got friends who are saying they're going to get a little nervous short term if they do a half. They think they should just do a quarter. But the bulk of people I know of, they kind of feel like, well, why wouldn't you do a half? I mean, let's just kick this off at a good start, because you got to realize the Fed's been on this path for ever since 2022.
Mm-hmm.
It's now a significant change. They're changing strategy, period. Now the tactic is, how fast do they lower rates? And you do have these people looking at this Taylor rule saying we should already be now at 4% is what they're wanting. And that's making some people nervous that maybe the Fed lowers, but they're just not going to lower fast enough. Something's going to hurt us first. And there are people out there that have always believed that once the Fed does start lower, you normally then slide into a recession, then it gets better, that they're picking up that a recession's coming. They start lowering, but things get worse. They've made a big mistake saying that. Not all of them, because some of them do look at it in greater detail. If you look at a greater detail, you find when the Fed does that, and then you slide into recession anyways, the economy was already sliding more than what we've seen. And most of my economic indicators is not sliding at all. It's saying the economy's moving forward. But you got a few out there. You can see things are a little bit slippery, broken up a little bit. Some businesses aren't doing as well as they used to. Yet I look how much money they made in the last 2 or 3 years, and frankly, I don't care. So, it's their turn not to do so well. It's time for someone else to do better. And we want to mention that in the stock market, because there's something fascinating going on there. They're buying more types of stocks than they have in years. But at any rate, for this whole lowering stuff, I'm definitely leaving the door open for half a point. Do not see more than that. And so it's a quarter or a half is how I look at it. And if it's zero, we got a problem.
Yeah. Okay. All right. So let's jump back to talk about the dollar a little bit. Now, you've seen some fluctuations there. We've seen the dollar slide a little bit. In your opinion, that's a good signal. Talk about that a little bit.
Yeah, it was supposed to be just a trader's signal to buy the dollar in recent weeks here and see a bounce into the Fed Reserve. This week, the model is saying, you can start bringing the dollar right back down now that you've seen that they're not going to keep pushing it higher to the Fed. And we're seeing the weakness. So the model really is not that confident, or I shouldn't say confident because it doesn't use confidence. I use the confidence in the model. So I rank that as my own opinion of the model. But the probability is rising that we may have just seen that dollar peak. I would like that. And the interest rates are already going down. The interest rates can also bounce the next couple of weeks because of the Fed. But it just looks like they're more serious about going down into November and the dollar. So if we get the lower interest rates, we'll get the lower dollar. They're going to kind of chase one another lower. What might hold the U.S. dollar a little higher, perhaps, and I suppose it could go the other way and make it drop even faster, would be its relation to the other countries. Because you have to realize when you're talking currencies, it's not just your country. You're trying to relate yourself to some other country. That's the only way you know your dollar is up or down. And so therefore, they also have to look at all those economies, those countries' economies, their commodities, their stock markets. They have to look at their interest rates, which is the number one thing, and plus the economy. And so we can see some fuzziness here where something else will go on. But I think in general, what the currency people are saying, they're preparing, or even the bond market people are preparing that if the Fed lowers, the rest of the world's probably going to lower too. Okay. Now, we already had England lowered a bit. Who was it? Canada actually was one of the leaders of the world here a few months ago, lowering. But we Americans are the big 800-pound gorilla in the room. Okay. So if we lower, the rest of the world's going to say, hey, I think we can breathe easier here. This whole inflation thing's over. They're going to lower as well. And this is exactly why I think we're going to have better exports and imports in the next couple of years, better global trade, despite all the politics and the trade war and this and that. I think things will get better if we can just lower those interest rates. And I think it's coming. I think it's going to work. If the Fed doesn't lower, I think it's really only going to be a month or two that I got a problem. And then I think the Fed's going to panic and lower. And that may give us another month or two of a problem, but that's about it. And then it'll be fixed, and we're going to get back on board anyways.
Okay. All right. So let's jump over and talk a little bit about what you see happening in the commodity market. So we'll pick on corn here to start with. Last 3 days, we've watched corn prices really rally. Sean Hackett was on here talking about technical marks somewhere around that 409 range in December corn. We've seen that. We hit that today at 409 and a quarter. It's kind of been bouncing back and forth there. We've seen some no change, and then about a quarter cent on both sides of that. I haven't seen what the market's doing here as of right now, but as you look at that, this is one of the first times in a long time where the commodity markets have rallied without the help of outside markets. So I guess your thoughts as you look at what's going on now.
Yeah, very pleased with what corn, wheat, beans, and wheat have done in the past 7, 8 trading days here. Model called what I call level 3 bottom. It's kind of like a once a month buy signal, and we also have a sell signal. Some people use it for their cash marketing to help them out, but it is a futures based thing. Other people use it to just trade the futures, speculative and commercial and farmer hedge, stuff like that. So it is short term. I just call it short term. Some people call it very short term. The problem has been that most of this year it's been down. And so you get these level 3 buys and it's up for a few days and then it just goes right back down. But it feels like something is changing here. And I've made more important calls, some of the most important calls you can make during a year. And I think on a long-term basis, we are due for bottoms now into early next year. And I just wonder if we aren't even dialing in this whole seasonal harvest thing even before we have the crop harvested, that we've just dialed in every bit of bearishness you can. We've dialed in the end of the world, anything. It's like the only way it can now go is better surprises for some upside. So I'm very pleased with what I've seen in recent days. Maybe it just blows over and whittles away on us, but I wouldn't be surprised. I'm as brave as saying we're looking at the lowest price for now into 2026, perhaps even beyond for corn. That's pretty brave, I know. But again, I have all types of signals and I can manage that and deal with that if it doesn't work out that way. But let's talk about what is corn really worth? And what I'm coming to the conclusion is, at least from an inflation adjusted basis, corn is as low as it was in the 1930s depression. And back then it was, I don't know, 18 cents, 13 cents, I forget now. But to me, I think that's ridiculous. And but I realize that's only inflation. That's just one of many components. But the interesting thing is I start looking at what it really should be worth. How do we actually use it? What are we going to do with it? I'm coming up with the same thing. This thing it deserves a long-term bottom. It is dirt cheap. Doesn't mean it won't get cheaper. Doesn't mean it won't go lower. It's just a big red flag for people who want to keep betting on the downside. In fact, I tell my subscribers, you want to keep betting on the downside, you better get more and more short-term. Be careful with that. See what you can get, because it's quite possible you're fighting for breadcrumbs off the table is all you're going to get. You want that loaf of bread. I think it's probably the upside in going into next summer, frankly, but it may take a while to turn that around. But a nice turn right now, and even on my subscribers, I show them a monthly chart when I have this green range, a little over $4 down to about $3.80, and the July-September markets did go below that a bit. The December, which is what that chart is actually using, shows we're about spot on. It's just resting there right in the bottom of that green range. That green range is linked to that idea of how cheap it is back to the 1930s. And I've got that range going out for years now. I think you're finding a floor price for a very long time. We may come back to it many times during the decade. I'm just saying you got to start thinking in terms of a bounce up. And then if you get another great crop, you're going to bring it back again. And then you work your way through that and you get another bounce up, okay? Now, here's another interesting thing. We get a once a decade buy signal in corn, just like we do the stock market. And the weird thing is, corn goes up 60 to 400%, but something like 90% of the time, it's been 100% to 400%, just like the stock market. I find that a bit odd, actually, because commodities are commodities, and then you have the stock market is something else. But that's what it does. Now, for the commodities, for corn, that is related to supply. Whereas, in other words, we have a supply problem, we have a weather problem. You don't get that, obviously, in the stock market. That's business. That's people in the stores and the factories. But it is interesting that it can come up with the same kind of similar performance. What I'm looking for is that this could be a decade buy signal right now, unfortunately, and I want to make sure people understand this. This is the only first opportunity. It could take a few years to find that bottom. We might go up and down, up and down, up and down. Finally, we get it. Then we get the big bang where we're up 100 to 400%. I'm very convinced now to 2030, we'll be up 100 to 400% once and maybe even twice, in the sense that these people looking at the Gleisberg cycle that can cause the problems in the 1930s, exploded grain prices and the Dust Bowl drought. In theory, that's due. I'm not as big a fan of it as they are, but I don't want to fight it. I don't want to get in the way of it. And that may strike in just the next 3 years. So I'm looking for this decade. There might be 2 big bull markets coming. But let's remember, and even I have a tough time remembering this, corn prices like to go straight up and then they go down for several years and a long ways.
Yeah.
And so, the farmer makes a boatload of money and then he gives it back over the next 5 years. That's, and then same thing for the investors, same thing for the investors. You see it time and time again. And I get caught up in it. And I'm thinking, oh, wait a minute, there'll be another bull run. And well, no, there doesn't have to be. All right. So just some interesting things going on right now, but it is so very long term. I can see why people aren't going to rush out there and buy corn. We do have a supply thing. We're refilling the bins, but boy, this world is so crazy on this climate stuff. And I'll be surprised if we don't get a little bit of a hit down in South America here, fourth quarter of this year and the first quarter for their crops, in other words.
Right.
And then if we can bring on La Nina, if that's part of that, I think the American investor, at least, and I would think the commercial farmer even, would be thinking, well, if that La Nina stays around into next summer, then that becomes a problem for us. Okay. Right. You're going to move that problem from South America to North America. And where's the rest of the world go? It could be very interesting next year for it just might be one of those times where we beat grain prices for a year and a half. And next thing you know, within 6 months' time, it's all the way back up. Who knows for sure? Right. Yep. But that's my scenario, and I want to broaden that out in the sense that I believe things like that can occur for wheat can actually do the same thing as corn, same thing. Beans is a bit different. You got to be careful. Its major long-term bottom may be a few years away. Doesn't necessarily mean it goes lower than where we are now. It could try to get on board with corn and wheat, and it will have those big bull markets too. And then when I go to commodity indexes, and currently the one I've watched different indexes, but the one I was recently interested in the last couple of days is the Goldman Sachs Commodity Index. It would be more related on energy, but I think that index can go up 20 to 30% in the next 2 years. That sounds like a lot, but really it's about similar to the one I'm looking for the stock market, strange enough. But to me, I don't think it's enough that we want to be scared of a resurgence of inflation. It really doesn't have to work that way. It could, but that's not the best forecast. I think what I'm saying is commodities did a very nice job for all of us of helping lower inflation. Now it's their turn to get paid back for helping out. In other words, prices are too cheap on the microeconomic rate. They need to bring that back. And we as macroeconomic traders, which I'm more of that, especially with the stock market, we need to acknowledge that and not get too scared over this inflation. It should be normal to see these commodities run up some. We don't want them to run up by huge amounts because the Federal Reserve will then sit back saying, wait a minute, instead of 2 or 3 commodities running up a huge amount, we got 20 or 30 commodities run up. That's going to scare them. Okay. They're going to say there's something going on here, companies gouging, and there's too much money in the system. Then the interest rates are going to soar. Okay. And then you're going to kill it, but you could still make a buck out of it on the upside, So those are some of the scenarios I'm looking at. And like I say, it just feels like even those commodity indexes, in theory, they shouldn't bottom to October to March for long term. But I'm starting to think some of those commodity indexes are bottoming now. They're just not going to move up too much until we can get into that normal bottom phase of October to March. And then they'll move up better. I'm convinced by summer next year, you'll see higher commodity indexes, and therefore maybe not all the commodities up, but I think it's going to be a decent run, and I don't think it's going to cause a problem for us in the economy and inflation. Right. And, I want to mention, since we did so much on interest rates and the Fed, I really believe the commodities are starting to wake up, that with the lowering of interest rates, there's less risk of hurting demand for commodities, less risk of hurting manufacturing, and it has hurt the manufacturing. I think they're going to start saying things are going to get better with lower interest rates. They're going to start asking for a higher price as it trickles towards the consumer, some of them. But again, I don't want to scare the consumer. They're not going to see this dramatic rush up. There's going to be a lag there and some rebalancing. But I just think the people, especially on the investment side, have been betting on the downside of commodities, and they clearly won. I think there's going to change, not their tactic, they're going to change their strategy. They're going to think something can change long term in these commodities, at least get some stability in there.
The weird thing about commodity prices, as you were talking about that, it seems like the world has you look at balance sheets and they have this huge balance sheet and it shows a bunch of stocks and everything else. And then 2-3 months later, they start re-looking those stocks over again. And they're like, maybe there wasn't as much as we thought, and then they readjust a little bit, and then they add some back, and then they'll readjust back down. It's just like, it's almost like they can't figure out which way's up when they're looking at their balance sheets, because supposedly farmers have all this crop in the bin, right? And we're going to have this massive crop, yet now they're reassessing their balance sheets now, saying like, well, maybe we don't have as much as we thought, and I think there's some of that going on. As you look at that, how are you making heads or tails of what's going on? Because it just seems like you get one report one day, and the next day you get the completely 180-degree different report.
Yeah. So I look for patterns of the data, just like I look for patterns in prices. And really, a lot of these analysts, they're looking more of a trend, and they don't deal that well with the short-term fluctuation. And I want the short-term fluctuation. I want to see the heartbeat of what is that fundamental information doing. I'll never forget, I was took my daughter, and we used to live in Florida, to an ice skating rink, and because she was getting lessons, and I'm sitting there on a bleacher, and I'm typing away, I'm updating people, I'm trading commodities, and finally a woman that worked at ER, emergency room, doctor, she come over and she says, she looked at my charts, and she looked at some of those indicators. She says, that looks like a heartbeat thing we use on our monitor in the emergency room. And I says, you know what? It's pretty much the same thing. And I says, I'm using this to decide, is the patient dying or is he getting better?
Right.
And then, but it was interesting. I said that because later I'm driving home and thinking about that. And I says, it's funny how you look at different things in life and you find similarities that can actually help you focus on something that you would think be more specialized enough. You just see these similarities. Yeah. And that's what I'm looking for in that fundamentals. And this business cycle stuff, it also shows you the time that fundamentals should change. And it's kind of fascinating to me. A lot of fundamental economists, analysts, it's funny, they don't really seem to know the time. They can get it right. Many years ago, I had a friend where we were working together selling analytical reports, and he had a forecast on soy meal prices and why it had to be very, very bullish. And I remember saying to him, I was writing the charting side of that and putting in my little opinion, something extra, but we were biased toward his analysis as our final opinion. I just says, I'm worried we're going to be wrong here. It's not the time for you to see that bullish number. And we just decided to go in and see what happened. So this was like literally 48 hours before the USDA report. The USDA report come out, and it was not a good one. Soy meal tanked. My model's sitting there saying, yay, yay. And I'm sitting there, oh, darn. Our final opinion was in the wrong direction.
Yeah.
And I felt bad for him because he's very well respected fundamentalist, but it just totally blew it, right? And he was just stuck. He just sat there saying, where in the heck is USDA coming up with that number? And do you know something, though? The very next month, USDA come out with his exact number.
Yeah.
Total turnaround. He was right all the way, yet a big down move, putting his opinion. And, if you wrote it out, you were right after all. But you just see that kind of stuff. It is difficult on all of us. It's a moving target. I don't care what anybody says, but I think I do a better job than most people with that moving target. But you've got to think of a moving target. It's like shooting a clay pigeon. You might be looking right at that clay pigeon, but you got to lead it. You got to have a range there to try to hit it, right?
Right.
And I love my model analysis in the sense that it can become extremely precise. But I always tell people there's no such thing as precision in markets or the economy. Right. And I look at that range, and then the modeling, what it does is it comes up with 1 to 3 little ranges inside, and it shifts those around. It's doing its best to zero in like a missile tracking system. Right. It also works like a clock. My clock is weird. It has 20 hands on it. But the interesting thing is that, and it's very sloppy, noisy. The interesting thing is at midnight, the hands you want are at midnight. So what you watch it and you say, there's no way in heck this thing's going to work. And then bam, there's your buy signal, your sell signal. You'll find out it works. It came together. So I don't know if I explained that very well, but the fundamentals are actually a little more difficult than figuring out prices by themselves. I actually also use what I call reverse modeling, where I forecast the price from price using these patterns. And if I think it's high probability, I'll say, okay, wait a minute. We're now going to say this forecast is bullish. We are going to be bullish going in and looking at that fundamental information and see if we come up with something like that first. Then later, let's clear our desk off, clear our brains out, and start over and act like a normal analyst. And let's look at that funnel information and see what we come up with. And then we want to compare to, and it develops this feedback loop. I think a way to simplify this for the average person out on the street is I'm doing fundamental and technical. Now, I have people get very upset with that because they are diehard fundamentals, and you have technical people who tell you fundamentals never work, never matter, don't even pay attention to it, just look at your charts. And they both do fairly well at it. But I find those moments when, boy, they're embarrassed, okay, that if you used both, you would not be embarrassed, okay?
Yeah.
And so I do my best to keep that in mind. I have a mindset of they both have something to offer. They can be at odds at times. They can be on board with one another. And I find most of the time they can be on board, but you need that perspective to begin with of actually use them. I say to myself, if you use technical only, you're driving with one hand behind your back. If you use fundamental, one hand behind your back. If you want the complete picture, I will say technical people, when it comes to very short-term trading, I'm convinced they really don't need anything else. They do very well. But I also know short-term traders, a lot of them don't make big money because they're always taking just very small profits,
Right.
And but they like it. That's how they do it. I know some people, they never have a long-term investment in stock and commodities. But I really like some of the bigger trends. I used to be a trophy hunter, so I'm not that interested in putting meat on the table. And so I don't do that anymore. But at least in the stock market, I can't help myself. I got to find those bigger moves during the year and over the years. But I'm pretty good also figuring out how are we doing, where are we going during the month, during the week. And I even help my subscribers in the sense of, well, today we'll be up, tomorrow we'll be down. I don't get any more detailed than that. They'd have to have me online all day long, and then they'll have to pay me $10,000 a year because I don't want to spend my life doing that. So I like those bigger moves and bigger profits. But I really do appreciate how the model helps us during the month, during the week as well.
Right on. All right, Rich, that's good stuff, man. That's probably a good place to stop for this one. If folks want to reach out to you, get more information about your podcast, where do they go find that at and how they get a hold of you?
Yep, go to criticalpointpod.com. And they can also go to criticalpoint.podbean.com. And you can also, ping, X me, Twitter, whatever it is.
Whatever it is these days.
At Rich_Posson. And again, I'm just getting started on Threads. I haven't said too much, but you can actually use the same address on Threads. Right on. Email me at rich@ag-financial.com. Send me a question or make a comment, and I'll see where we go with it.
Sounds good, man. Well, Rich, appreciate you being on. We'll catch you again next month.
Thank you very much.
Right on. I'm Casey Seymour with Moving Iron Podcast. Check me out on Facebook, Twitter, and Instagram at Moving Iron LLC. Go to LinkedIn at Moving Iron Podcast. Check out the video version at the YouTube channel, which is the Moving Iron Podcast YouTube channel. And I guess we're done trying to get rid of TikTok. So I'm still on TikTok. You find me at Moving Iron Podcast on TikTok. You can go to movingironllc.com and you can find information there. If you're an investor, if you're an equipment guy, if you are a analyst, if you're any of those kind of people and you're interested in coming to the Moving Iron Summit, hit me up at Moving Iron Podcast and movingironpodcast.com, or you can go to the website movingironllc.com and check on the ribbon at the top that says Moving Iron Summit up there, and you can get the information there. Rich will be there talking about what's going on from his perspective as we head into the last quarter of the year, going into 2025 already. Can't believe that. It's almost here, Rich. Yeah, moving right along. Moving right along. So with that, I'm Casey Seymour with Rich Posson. Let's move smart, folks. Out.
Iron Podcast is brought to you by these great sponsors. Are you looking to value your equipment more accurately, target the right buyers and close more deals, reach your ideal customer? Then look no further. Fusable isn't just about ag data, it's about action. Our best-in-class solution empowers you to value your equipment accurately, make informed decisions, and find the perfect prospects. Ignite your dealership's growth at fusable.com/movingiron-podcast. Out in the field, every decision counts. You wouldn't plant without testing your soil, so why would you prospect blind? Introducing EDA, your one-stop shop for ag equipment intel. EDA goes beyond specs and prices. You get deep dive data on every piece of equipment like UCC filings that help track ownership changes and uncover potential sales leads. D&B firmographics, which help you understand the financial health and buying power of potential customers. Market trends that help you stay ahead of the curve, and insights on equipment demands and pricings. With EDA, you're not just looking at data, you're seeing opportunity. Find the right buyer, sell smarter, and build lasting relationships. Visit edadata.com for your free demo and unlock the power of knowledge. For over 80 years, Iron Solutions has been your go-to data source for ag dealers, lenders, and manufacturers. Get powerful appraisal and value forecasting tools that fuel profitable decisions anytime, anywhere. Get your free demo at ironsolutions.com. Iron Solutions, confidence in every click. Today, there are many ways to finance ag equipment, but nobody delivers simple, fast, or flexible financing like AgDirect. Learn more about your options to buy, lease, and refinance equipment at agdirect.com. Valley Transportation has been hauling ag and construction equipment across the country for the past 33 years. Call Parker at 800-657-4910 for all your trucking needs. At Valley Transportation, our goal is to help you reach yours. This podcast is proudly provided by Axon, helping dealers move more iron for the past 100 years. Find out more at axontire.com. Move more iron with Axon.
Moving higher in the 21st century.